In this video, we are going to talk about stocks that pay over 10% in dividends. So before starting this video, please like this video and subscribe to this channel for our future updates. When the year draws to a close, it's a good time to look forward to 2020. While the US economy is still booming, there are some dark clouds looming on the international horizon. There are indications that the Chinese and European economies are slowing, and there is fear that a global recession could spread to the United States. Dividend stocks are a good income-generating choice for investors who don't want to leave the market but want to protect their income. We searched for stocks with a very big dividend yield, specifically over 5%, a high enough yield to pique the interest of income-seeking investors using the TipRanks stock screener method. We also filtered our database search to reveal only buy-rated stocks with a 10% or higher upside potential. The screener found 185 stocks that matched our search criteria out of a pool of over 6,400 publicly traded stocks, a much more manageable number with plenty of interesting stocks to choose from. We've chosen 3 from a range of industries that give a good mix of high yield and space for expansion. Let's take a closer look at them. Capital Product Partners, CPLP. Even the most brilliant ideas pass us by almost unnoticed. One of those ideas came from the man who designed the now ubiquitous metal shipping container. With a few uniform sizes, the container makes loading and unloading simpler and quicker, allowing larger cargo ships to be filled to higher capacities. In a nutshell, the container transformed the shipping industry. One of the businesses that has benefited from the shipping container is Capital Product Partners. The company specializes in seaborne freight transportation, including both containerized and dry bulk cargoes. These are transported by an 11-ship fleet, which includes 10 container carriers and 1 dry bulk carrier. The bulk of these vessels have operating agreements in place until 2022 or 2023, according to Capital. Earlier this year, the company consolidated its activities by selling its tanker fleet to DSS Holdings. The tankers are still part of CPLP's management, but the company is no longer responsible for their service. CPLP earned $3.4 million in the third quarter. This translated to an EPS of 18 cents, a small amount but a significant increase over the previous year's loss of $1.33 per share. The total revenue for the quarter was $26.4 million, down 17% from Q3 2018. The loss of revenue was due to the withdrawal of 2 vessels from the carrier fleet, according to the group. Investors were unfazed by the sales decline. Investors are drawn to the company's profitable assets and solid dividend, so CPLP has gained a small amount since the quarterly report. The only flaw is the EPS, which isn't big enough to support the 32-cent quarterly dividend payment in the long run. However, the organization has maintained the payment for the past year, demonstrating a commitment to sharing profits with customers. The annualized yield of 10.7% is very impressive. B. Riley FBR's Liam Burke, writing on CPLP, sees a straightforward way forward for the shipping business. The underlying market for container and dry bulker vessels remains stable with the reduction in excess capacity in both fleets, which should also lead to healthy long-term charter rates, he writes of the industry's future prospects. Although existing bulker capacity remains relatively tight, underlying demand for commodities continues to rise steadily. In line with this, Burke rates CPLP shares as buy with a $14 price goal, suggesting a robust 19% upside potential. The analyst consensus on CPLP shares is strong buy, with 3 reviewers giving it a buy recommendation in the last month. The stock is currently trading at a discount, at $11.71, and the average price target of $14.67 indicates a strong upside of 25%. Amplify Energy, AMPI. Exploration business for oil and natural gas comes in second. Since 2008, when fracking techniques started to spread across the industry, rendering previously unrecoverable oil reserves available, the energy sector in the United States has been booming. Amplify calls itself a upstream firm, which means it primarily purchases assets and extracts the oil and gas resources from them. The company's primary operations are in Texas and Louisiana, but it also has operations in Wyoming and off the coast of California. Amplify has over 1,400 operating wells on its various assets, with another 1,000 in construction or inactive status. The company has proven reserves of over 900 BCFE, billion cubic feet equivalent, an industry term that equates energy resources to the standard measure for extractable natural gas. Amplify's shareholders approved a merger of equals deal with Midstate Petroleum in August of this year. The merged business is known as Amplify and is based in Houston, Texas. Amplify began paying a quarterly dividend in the third quarter of this year. Although the amount is small, 20 cents, it is a good start. Since the company's stock is currently trading at a low price, this first dividend payout yields 14.2%. As compared to the S&P 500's average yield of just 2%, the appeal is clear. Amplify has piqued the interest of two Wall Street analysts, who have initiated coverage of the stock with buy ratings. We think AMPI is a differentiated E&P as it is currently producing substantial FCF, which funds a meaningful quarterly dividend of 20 cents per share, Northland Securities' Jeff Gramp wrote. We believe the company's diversified, low-decline asset base supports this business model, and we believe it will find accretive acquisitions, as it did when it merged with peer Midstates Petroleum in August 2019. With Gramp's price target of $10, AMPI stock has a whopping 70% upside potential. Roth Capital analyst John White is also optimistic. AMPI, in our opinion, presents a compelling investment case due to many major factors, among which are 1. A unique financial strategy in the U.S. E&P sector devoted to a strong return of capital program involving dividends and stock buybacks, and 2. A collection of oil and gas properties that are based on quality properties, White says. White backs up his buy recommendation with a $10.50 price target, implying an 86% upside potential. After the Midland acquisition and the launch of the dividend, AMPI stock began to attract analyst attention, indicating that the business is on track. Both of the above reviews conclude that AMPI is a worthwhile investment. The average price goal for the stock is $10.25, implying an 82% upside potential. Broadmark Realty Capital, BRMK. Real estate investment trusts, REITs, will still appeal to dividend investors because they are required by law to return capital to shareholders. Dividend payout ratios, the ratio of the dividend to the EPS, of 85% or higher are not unusual in REITs. In other businesses, this would be unsustainable, but the tax code mandates it in this sector, and the existence of REITs means a consistent cash flow to cover the dividend. REITs are companies that purchase and operate commercial and residential properties. Broadmark is a traditional mortgage company that specializes in the rehabilitation and subsequent construction of purchased properties and maintains a diversified portfolio of secured loans for real estate investors and developers. Trinity Merger Corporation and Broadmark Real Estate Lending merged in November, resulting in the formation of the firm. On November 15, the new company began trading publicly. As previously stated, the tax code allows REITs to return a significant portion of their earnings to investors in the form of dividends. Broadmark announced its first dividend last week, which will be paid on January 15, 2020 to all shareholders of record as of December 31, 2019. The dividend would be the company's first under the BRMK ticker, at 12 cents per share. B. Riley analyst Timothy Hayes initiated coverage of BRMK shares in November, when the stock first started trading, and took a bullish stance. We believe the dividend is currently set at a level that does not represent the true earnings power of the platform pro forma for deployment of capital acquired through the Trinity merger and for private AUM growth, he wrote in his second note on the stock last week, reiterating his buy recommendation. As a result, we expect the dividend to gradually increase during FY20 as earnings power grows, resulting in a much more appealing dividend yield than the current annualized dividend suggests. Hayes reiterates his buy rating by setting a $13 price target for BRMK, implying a 9.5% gain in the next 12 months. BRMK is a new ticker on the stock exchange, so it hasn't had much time to gain traction on Wall Street, but it has already gained 2 buy scores in its first 4 weeks of trading. The average price target of $12.50 represents a 5.3% increase over the current trading price of $11.87. What do you think about our video? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.